This one fund owns Constellation Energy, the company restarting 3 Mile Island to power Microsoft's artificial intelligence. It also owns Cameco, the biggest name in uranium. On paper, it's the perfect way to play the nuclear for AI boom. So why did it return just about 7% this past year, while pure uranium funds nearly doubled? Meet NLR. NLR is the VanEck Uranium and Nuclear ETF, and here's the twist most people miss. It isn't some hot new launch chasing AI headlines. It has existed since 2007. This is the original nuclear ETF, the one that sat quietly through a decade when nobody cared about atomic power. Today, it manages around $3.7 billion. And suddenly, everybody cares. The data centers running artificial intelligence need staggering amounts of always-on electricity, and the cleanest way to deliver it around the clock is nuclear. That one story turned a sleepy corner of the market into one of the hottest themes on Wall Street. NLR tries to own the entire nuclear supply chain in one ticker. At the top sit Constellation Energy and utilities like Public Service Enterprise Group and Finland's Fortum, the companies that generate and sell the power. Alongside them are the fuel miners, Cameco, NexGen, and Denison, plus specialists like BWX Technologies and Centrus that build reactors and enrich the fuel. So it holds the AI power winners and the uranium miners together. And here's the catch nobody tells you. Owning a little of everything is exactly why it lagged. When uranium prices spiked, funds packed only with pure miners captured the full surge, and some soared past 100%. NLR, spread across steady utilities and companies that are roughly half foreign, barely felt that rocket. This is the most important lesson in ETF investing. The label tells you the theme, but the construction tells you how the fund will actually move. Two funds can both say nuclear on the tin and behave completely differently. A broad basket like NLR gives a smoother, safer ride, but it will never spike like a concentrated pure play bet. Diversification trims your losses and your winners at the same time. That trade-off shows up in the numbers. Over the past year, NLR returned roughly 7%, calm next to the wild swings in single uranium stocks. It also pays a distribution yield near 3%, income that comes mostly from those boring, reliable utilities the pure miner funds don't own. So who is NLR actually for? It fits the investor who believes in the long, multi-year nuclear build-out, but doesn't want to gamble on the daily chaos of one mining stock. You're trading explosive upside for a steadier way to own the whole story, utilities, fuel, and technology together. Just be honest about which bet you're making. If you want the fireworks of a uranium spike, this isn't that fund. And a global basket like this carries policy and currency risk from its foreign holdings. It's the calm, broad option, not the lottery ticket. If this helped you understand why two nuclear funds can perform so differently, hit like and subscribe. Then tell me in the comments, are you team broad and balanced like NLR or team concentrated and aggressive? I read every reply.